Trading is one of the few professions in the world where you can put in 100% of your time and effort and still come out with nothing on the other side. And that's why I was very excited to sit down with Gregory Collier, who's had an amazing professional career in the investment industry, working at some of the biggest investment banks in the world, including Lehman Brothers and Citibank. He's also an author, a speaker, and now a full-time consultant where he supports these investment firms from an analytical point of view. In today's episode of Trader's Edge, we're sitting down with Greg to talk to him about his life story. How did he get started in this industry? What led to him developing a passion for finance at such a young age? And what steps did he take to find his own way in the investment industry, building out his own career, and going on to achieve success in an industry that is so cutthroat? So, on today's episode of Trader's Edge, I have a very special guest with me, Mr. Greg Collier. How are you doing, Greg?
Doing great. How about yourself?
Greg, I'm doing fantastic. Thanks so much for taking an hour out of your time here to come on and talk with me.
Sure, my pleasure.
Perfect. Greg, look, we'll hop right into it because, I don't want to waste any time here. You have a really interesting story. It seems like you've really managed to make it in the financial markets. And, I really want to get a chance to delve into that. I think our viewers, will find it really interesting. Just to start off, why don't you tell us a bit about like your upbringing? I just want to hear a bit more about that.
Sure, absolutely. I was born in West Virginia, Charleston, West Virginia, and shortly after I was born, my family moved to Brooklyn, New York. My father's from Queens, and my mother is from Brooklyn. So I lived there till I was 3. And just a high cost of living. My father got an opportunity in Detroit, so that's what took us to Detroit. So I lived there till I was 14, and then we moved to a suburb called Farmington Hills. And I graduated from high school, and then I went on to college at Florida State University.
Was the opportunity for your dad in the auto industry? Because I know that's big out there.
No, it was actually with a company called Dansk, and they make like glassware, things that people would buy on in a wedding registry.
Oh, interesting. So
Dansk, I believe, is the spelling. So it was just an opportunity that relocated us from Brooklyn to Detroit, and they were happy to go because just much better cost of living relative to the New York tri-state area. Though New York is a couple-hour drive.
Yeah, we thought that we have it bad here, and then I looked at the prices of housing and real estate in New York, and it made me very grateful for where I am.
Yes. You should absolutely be grateful.
So I had to look through your website and everything prior to our call, and I was absolutely astonished with the amount of education that you have. So you said that you started at FSU, but I could see that you've attended multiple places, received many different designations.
Yes.
I'd love to know a bit about prior to getting into that, I noticed that everything is finance related. Was your interest in finance? How did you get into that? What sparked that interest for you?
I got into finance because so many people end up destroying their life or having a much worse quality of life because their lack of understanding of finance. And my family is an example, much of that's included in my book, where pretty much everyone did well financially, but would spend every penny they made on things that really didn't matter for the most part. And when an emergency happened, it created a very problematic situation. And this was almost everyone in my family. So I made a decision early on that I was going to learn as much. When I say early on, I'm talking by the time I started high school, I made a decision that I was going to learn as much about finance as I could, all aspects of finance, so that I can have a far better quality of life than many people I know, and particularly many family members. So that's how I got interested in finance, and I decided to majored in finance and accounting at Florida State.
Wow.
And even my choice of going to Florida State was strategic. I was going to go to Michigan State University, but my mother had moved to Florida, and she had moved to Florida. My parents were divorced. She moved to Florida my junior year in high school. So because she moved to Florida, I was able to get in-state tuition in Florida. And at that time, as a in-state resident in Florida, it was less than half the cost of going to Michigan State as an in-state resident in Michigan. So that's why I ended up going to Florida State. I wanted to go to college be able to afford to go and just pay for it and not have to ever get student loans. So I went to college. I didn't have a fancy apartment or anything like that. I didn't have a car. And I ended up graduating with 0 student loans. So
That's
whereas
unbelievable.
even today, there are people who I went to school with who they maxed out on student loans. They had nice apartments. They had fantastic cars, even with the low cost of being an in-state resident in Florida. They're still paying off student loans today, and I was fortunate never to ever have them. So that was a strategic financial decision for me.
I wish I had that type of intuition when I was that age.
And so that, everything just built on finance. My plan was I was going to graduate from college, then I was going to either go to law school or get an MBA. And in my particular case, when I graduated from college, I didn't have any money. And I decided, you know what, I want to work for a couple of years. If I'm going to work in finance, I did not want to work at some commercial bank in Florida or in the Southeast. The one place New York is a financial capital of the world, so that is where I decided to go. So, to make a long story short, I started working in New York. I can't say I fell in love with the work I was doing, but I loved what I was learning. And that all of this was strategic, and much of this is in my book as well, The Janitor's Son. The Janitor's Son, The True Story of Hope, Shattered Dreams, and Winning Despite Adversity, that I self-published in 2012. I ended up going to New York and without a job, and I initially lived with family. My uncle lives in New York. I still have a lot of family in New York.
Wow.
And I ended up getting a customer service job with a bank. I don't know if they're still around, but First Chicago. I ended up getting a customer service job
with First Chicago,
where I was going to I'd be answering the phone and handling basic banking queries. And there was a lag between the time I was supposed to start that job and when it was offered. So I ended up getting an opportunity via a temp agency, of which there's a ton of them in New York.
Okay.
And lo and behold, I walked in the very first day. At that time, it was Manufacturers Handover Trust Company at 270 Park Avenue.
Okay.
Ultimately, through a bunch of mergers, through a merger, it became Chemical Bank.
Yes.
And the CEO of Manufacturers Handover, John McKilligutty, became the CEO of Chemical Bank, and then ultimately is part of the J.P. Morgan Chase entity that exists today. To make a long story short, I walked in on the first day in a low-paid for New York temp job where I was going to be a filing clerk for just 2 weeks. And it was on a trading floor. It was on an emerging market fixed income trading floor in the early 1990s.
Wow, you must have looked around and been like, what just happened?
I was in complete shock, but I did the job that I was supposed to do. I was a pretty good filer. And my boss was shocked to find out I had a college degree, because it was something that didn't require a college degree. They just wanted somebody to file documentation all day. So he started giving me some additional tasks within the first week, and then he asked me if I'd be interested in staying on. And even though the job at First Chicago paid more, I saw that I was going to learn so many things. I would have the opportunity to learn so much that I ended up staying at Manufacturers Hanover Trust Company, and the rest is history. And that's when I first got interested in. That was my first exposure to trading. That's when I got interested in trading.
Was trading even on your radar prior to having that job?
No, not at all. I just wanted to learn as much as I could about finance. I didn't even really know that one could have a career trading. And this was prior to when there were very many day traders, because the internet was early 1990s. So no one had a computer. No one had email. We just dealt with a lot of paper at that time. So all of these discount brokers that exist today, none of them were even around back then, for the most part. I know Schwab existed, but you could not just. You would have to pick up a phone and call a broker to actually do a transaction. But that's where I started to see that I had some possibilities. And the big break, actually, after getting there and being there a short time, I was hired as a permanent staff member and given a nice jump in pay, given greater duties. And for the most part, the people who trade, this was a emerging market fixed income trading desk. So they're trading in increments, smallest increments, about $1 million per transaction.
Wow.
Most of those people had MBAs from Harvard, Stanford, Yale, top schools.
Mm-hmm.
And I was able to learn a lot, but the likelihood of me being able to become an institutional trader was very minimal. But either way, I tried to soak up as much knowledge as I could. And that's one of the things that a lot of younger people today, when they start their career, they're more interested in how much money they're making. They're not really thinking about where it's going to lead. And the breakthrough that caused me to think deeper about ultimately becoming a trader with my own capital on my own account.
Yeah.
This chemical bank sent me to the merger took place like my first year at Chemical Bank.
Oh man, you must have been busy.
Over in Chemical Bank, so it's definitely busy. Chemical Bank sent me to London to take place of a vacationing trader's assistant on a trading floor there. And my mother, who was a real estate broker in South Florida, demanded that I reach out to one of her clients, a British national who she had sold a house to. And so I reached out to him. I ended up meeting him at his flat in London. And it just so happened that this guy he was a retired institutional foreign exchange trader.
Wow.
And he still worked, but he worked from home, trading on his own account with his own capital, trading FX. He had a couple of computers set up. So we had, at that point in time, this was the mid 1990s. We had transitioned from the point where people went from not having computers to having computers.
Okay.
The internet was starting to become robust, and where you started to have online brokers where people could actually do transactions online. So that's where we happen to be.
So you were in England, and you got connected with someone that you had a mutual connection with, who was actually I guess semi-retired institutional trader. And how did that experience go? Like, how long were you in England, first of all?
I was only there for 2 weeks.
2 weeks. So
yeah, it was,
you mentioned this.
Just seeing what the gentleman did caused me to think, hey, wow, the internet is becoming more robust. I could do the same thing this guy is doing.
You sort of saw the opportunity.
I could sit at home and I could trade on my own account with my own capital. If I'm successful and I'm able to be profitable, then that's what I can do. And so at that point in time, I made the decision that at some point I was going to just trade on my own account with my own capital. But my decision was that I was going to continue working in corporate America because things were going pretty good. I was going to be careful with my finances. I was going to live significantly below my means and build up as much capital as I could via investing for the long term, what have you. And I planned on retiring from corporate America by the time I turned 53, and I'm not 53 yet. And then fast forward through the years, while I was working, ended up getting my MBA in finance. I did some other training along the way, and had some other jobs at other companies. But
yeah, I see here you went to Oxford for a while.
I did complete a program at Oxford. I completed the private equity program at Oxford. It's about a 1-week program. I do dabble in private equity a little bit. I do some recruiting for some firms who seek high net worth individuals. So over the course of my career working in New York City, I was fortunate enough to come in contact with quite a few high net worth individuals. And periodically I will get pitched various deals where they're seeking to create a private equity portfolio for a particular set of investments. And they end up seeking funds generally between $250,000 and $2 million per person, depending on the structure. And then basically, whatever I bring in, I get a percent of that for the life of the portfolio. So
Oh, wow.
that is actually quite lucrative.
How did you end up
at
getting
time.
into that?
I ended up getting into that because out of the blue one day I got a call from someone I used to work with who was then working at a private equity firm, trying to find out if I had anybody who would be interested in investing in a particular fund. And that's how I got into it. It was simply a relationship that I had built over time.
And I guess if
So
you're coming from sort of corporate America, you probably had a lot of these connections already.
Yes. So that's how I actually got into that, and that's something I do on the side of trading. I generally I don't seek out anyone unless I'm called and asked to look at a particular deal.
And you get a percentage of their contribution for the lifetime of the portfolio.
That's correct.
That sounds like the dream.
Yeah, it's nice extra pocket money. So it
Definitely
works out fairly well for me.
That's amazing. And just to touch on this here, I see that you actually run a consulting firm as well. Is this what you're talking about with the consulting?
I do that through Collier Capital Advisors, and initially I had set that up for the possibility of being a financial advisor and getting assets under management.
Mm-hmm.
But I don't use the entity for that. I use it for the purpose of recruiting private equity, providing some research to private individuals who might want me to do some analytics. I'll get calls on certain projects from people, and they'll want my opinion on them. So I'll dig in and I'll see what I can do for a fee.
Mm-hmm.
So that's what I do with Collier Capital Advisors.
Interesting. For someone who's been in the industry so long, I can't imagine the amount of drastic change you've seen over the years in how retail traders operate, what's happened in the institutional side of things, how that's evolved. What do you think has been the most significant change in the last, decade or 5 years even within the world of trading?
Well, it's the technology. Because now anyone can have a pretty robust trading platform that's completely free, basically by just having a brokerage account.
Mm-hmm.
Whereas 20 years ago, that was not the case. 15 years ago, the cost of trading was a lot more. And now we've even migrated to the point where commission free is very, very common. And commissions,
mm-hmm.
as you know, eat up a lot of profitability.
Yeah, completely destroys the edge for a lot of strategies.
So, I mean, there's a trade-off with the free commissions now in that far too many people have brokerage accounts and work around prices not being quite as good, a larger bid-ask spread, what have you, and maybe
mm-hmm.
slightly slower executions. It still works out to your advantage, but you got to kind of work through some of the kinks, and hopefully things will get better. I know there's been some lags with various brokers because of that and because of the high extra volume, because of more people having accounts than ever before because of the free.
Mm-hmm. And it's really changed a lot of things as well. But I'm based in Canada, right? So we're a little bit behind you in terms of free commissions. The best we have is we use Interactive Brokers, and we get $1 commissions.
Well, still better than $9.99.
Yeah, exactly. Right.
Or more.
It's crazy. If you go with any of the big banks, so Interactive Brokers is pretty much like the biggest discount brokerage. But if you were to go with, TD America, TD or anyone of that nature, I believe TD, like Thinkorswim, is $4.99 a trade. And then if you go with like CIBC, it's like $7.99 a trade.
Okay.
So we still have that in Canada.
Okay.
No one's been able to enter our market with free commissions, probably because of the size of our population. It doesn't make it worthwhile. But yeah, we're yet to have that. So still waiting.
Well, hopefully they add that for you. I do communicate with people from Canada periodically, and I know that some of the platform issues with lags and data and bad executions are still, people in Canada are actually feeling that as well. So so hopefully you guys get at least free commissions if you're still going to have to deal with some execution
So
issues.
Greg, what assets do you like to trade?
I primarily trade options, and I have used multiple strategies over the course of time. I kind of found something that I really liked. I mostly trade options on technology stocks, and Apple is the stock that I trade the most. I trade Apple almost every single day.
Wow.
The reason I trade Apple almost every single day is just over the course of time, watching it. Number one, it's highly liquid, and the options are highly liquid. The spreads on the options are fairly tight, so I can pretty much get in and out with whether it's a small size transaction or a larger size transaction. When I say larger size, 100 contracts or more is what I'm considering. A larger size, and it allows me to get in and out pretty much at will. And that's one of the reasons why I like Apple. And it's as far as stocks go, it's as predictable as any stock I've ever seen. So that's part of why I trade Apple.
Mainly options.
Mainly options. I've very recently started to trade futures. I did some intensive training in futures years ago, and I just never ever traded them. But last week was the first time I traded futures in years, and I traded futures almost every day last week, and I did a little last night, this morning, and a little tiny bit today. I didn't do much trading today just because of the high level of volatility and being extra careful around this time.
What are the major metrics that you look at when trading options? Are you someone who's volatility oriented? Are you using them for directional bets?
When I'm swing trading, I am looking at things like volatility. When I'm scalping, because which is very dangerous, I scalp options in the short time. I'm not really looking at volatility. I'm really mostly looking at the movement of the underlying stock and how fast it's moving. And if it's moving fairly quickly, I will potentially jump in. I'll buy at the money call option. If it's moving up fairly quickly, I'll jump in and potentially buy at the money or one strike in the money call options and try to get anywhere between a 10 and 20% gain. But strategy, the main strategies I use is I gap trade in the morning. And there's a couple of different variations of it. How I gap trade is, say Apple closes at a particular price on today's Tuesday. Say it closes at a particular price on a Tuesday, and it opens at a lower price on Wednesday. I will generally wait until after the first 1 minute candle. And if the second 1 minute candle opens above the first 1 minute candle, I will buy, and the market is generally rising, I'll buy at the money call options on Apple or one strike price out of the money call options on Apple, expecting for the gap to either fill or partially fill. And by that I mean the price where it opened on Wednesday, which is below the price where it closed on Tuesday. I'm expecting the price to rise and try to meet the closing price on Tuesday. So that's one of the strategies that I employ. And I'm oftentimes I'm so successful at that strategy that I stop trading for the day. I'm done by 10 a.m. I try to do most of my trading in the morning. But if I meet a certain profit threshold, I generally stop and just protect my profits. And I don't trade again unless I see something that I think is absolutely a can't miss situation. And then when I do transact in those cases, I use smaller size.
Yeah.
And the reason I do that is I've had dozens of instances where I've been up, say, a good amount of money in the morning just to give it all back in the afternoon, or get half of it back in the afternoon. And I had a day where I was up $13,000 by 10 a.m. That was one of my better days. Which I made it every day, but I don't. And I ended up finishing that day about negative $5,000.
Oh, Jesus.
And that's because I was like, wow, I've got $13,000 in my hand. I'm going to stretch this to 20.
Yeah.
And then trade after trade after trade. After that, just a series of blunders. Next thing you know, I'm like, okay, let me do one more trade to get me back to 13,000. Nope, negative 5,000. So
Oh no.
since then, and a few other issues problems I've had. I generally, if I'm profitable by a certain amount by 10 or 11 a.m., I just stop trading for the day and I enjoy my day. I live in Florida, so the weather's generally nice. I try to get outside and have some fun, or study something, read something. But I have to turn my computers off, because if I keep watching them, I'll see something that intrigues me, and I'll jump in.
So I wanted to ask you, because
Sure.
not many people get the opportunity, or people that will be listening to this podcast will have had the opportunity to have worked in both an institutional setting and in a retail setting, where they've worked trading other people's money, and also worked in a situation where they're trading their own capital. So I wanted to ask you about what the major differences you see between those two sort of facets of trading. Because I assume, having the opportunity to work in a big firm, you've had access to large data sources, large data pools,
Yes.
Quantitative analysts that can help you build models, all
That's
of this
correct.
type of stuff. And our background Predicting Alpha's background is, we work in that space. So we basically are in the process of building out our Predicting Alpha terminal, which is for an options trading. And what we do is we basically take all the data that options traders look at, and we visualize it and present it in the form of like a mini terminal.
Okay.
So, I just, because, not many people have got to seen this side of things, whereas you have had the opportunity to do so. What do you see as the major differences there, and why do you think that's the case?
Well, one of the major differences is you're obviously an institution. You're dealing with more capital. And when you're dealing with more capital, your trading strategy has to be different. One of the reasons the trading strategy has to be different. So, say for instance, I decided to do a extremely large option trade. I'm not going to get necessarily the best pricing if I do more than 100 contracts, say on Apple. If I try to go in, say, 300 or 400 contracts, my pricing is generally not going to be as good. So I need to phase in. So institutions, they have to phase in, and they're dealing with dark pool situations to help kind of mask their ability to get worse pricing. So that's one of the major differences. And even dealing with say a dark pool, a super large order can influence the market. But with the capital I'm using, there's no capital that I currently have that is going to cause Apple to rise 2% or go down 2%.
We're unfortunately not
at that level. I'm not at that level yet. So that is a major difference. Another major difference is at an institution, they have certain objectives, obviously, that individual traders must meet. There's a different type of pressure when you're trading with someone else's money. I'm not saying there's no pressure, but there's a different type of pressure when you're trading with someone else's money than it is if you're trading with your money. If you're trading with someone else's money and you make a grave error, ultimately, it could lead to being dismissed from an opportunity. But if one thing I tell retail traders, the more money you have, the easier it is to trade. By that I mean, if someone decides they want to trade on their own account with their own capital, they want to quit their job, they want to walk away, if they have enough money that they can live without making any money, then it's much easier to trade. So if I have to make a certain amount in the next 3 weeks to pay my mortgage on April 1st, and I have a bad day or two, and now I'm like, okay, I might come short, then you up your risk and don't necessarily think as clearly. And that is one of the bigger differences between institutional trading and retail trading. An institutional trader can generally think clearly most of the time, despite dealing with the high level of volatility. He's obviously going to get compensated in terms of a bonus the better he performs, but it's a different type of pressure. The biggest pressure is if you really need the money, and you just will not think as clearly. A quick example.
Yes.
There are a lot of guys who offer trading services, alert services, chat rooms where they'll give trading advice. Some of these guys are making so much money from their chat rooms and their alert services that they don't need any money to trade. They don't need to make any money trading. They're making so much money on the chat room. So when they do trade, they're able to sit back, relax, knowing that they have a ton of money coming in regardless. They're able to isolate certain trades and execute them extremely well because the pressure is just not there to earn an income.
What are your thoughts on that, actually? You've been on Instagram for quite a while. You've built a nice little following for yourself, and you've done so just giving out a lot of great free information. I'm really impressed with it, actually. It's one of the reasons why I was very happy to have you on the podcast. But obviously you've seen sort of some of the side of the retail education space, right. With everything going on Instagram, with these mentorships, with chat rooms, with everything of that nature. What's your view on the direction that retail trading's headed? For it, against it, think there's room for change? Just what's your opinion on all of it?
There's definitely room for change. And one of the reasons why I started providing free advice, I do not have a trading service. I do not have a chat room. I do not sell training classes. One of the reasons why I started giving free advice was because I see so many people who they're paying they're taking a $1,000 class or a $500 class, thinking that that's going to teach them how to trade, and then they find out that they've gone through this class and they still can't trade. I see a lot of people paying $30 a month for a particular chat room that gives them alerts throughout the day, and then all they're doing is losing money doing these trades. And a lot of the guys who are running these, you can't trade their way out of a paper bag. They're just out of a wet paper bag. They can't trade. They really don't know what they're doing, but they've made it look good.
I agree.
And I saw someone with a Robinhood account. They're creating charts on Robinhood. Not to knock Robinhood. I know that they were the first to start offering free commission, but it's not a good trading platform.
Yeah, it does. You're much
trading.
Better off with like TD Ameritrade or even they've been in some hot water recently.
With Robinhood, it's better to just, if you're going to buy and hold and add to it, sell very infrequently. But I've seen people trying to sell alert services who have a Robinhood account, and they're posting on their Instagram page the $40 profits on a particular transaction.
Like, what the heck is going on?
And I'm like, listen, that is so that's part of why I started giving free advice, just to kind of help people know that, hey, trading is not easy. It's extremely difficult. Anyone who says it's easy, trading in the short term, anyone who says it's easy is either lying or they don't know what they're talking about.
Exactly.
And that's really why I one of the main reasons I started showing my wins, showing how I did certain things, and provide free advice. Now, there are some people out there who actually do give their alert services actually are good. Their training classes actually are good. But even if one takes a detailed training class, you will never, ever actually be able to trade unless you actually practice trading in a live environment with real money, because the most difficult part is the psychological aspect of seeing yourself lose money or potentially lose money, and how you handle that. So I try to talk a lot about that, and the alert services. it's something that should actually be regulated, in
Mm-hmm.
my opinion, because there's just so many of them. If you go through Instagram alone, you'll find thousands of them. You go to
I
stock
agree.
twits, you'll find thousands more, and that's pretty much out of hand, and just unsuspecting people find themselves just really in if you want to make money, you sell people hopes and dreams.
Mm-hmm.
They don't have to have any it doesn't have to have anything behind it that actually works. But if you sell them hopes and dreams,
Yeah, I don't know if it's
that's what people want.
I don't know if that would pass the mirror test for most people, but I know exactly what you mean.
Right.
But I speaking of the psychology, prior to us building out this predicting alpha terminal, our previous business model was we used to basically just take proven profitable strategies, and using our quantitative background, we would actually just build models for executing on them. So it's like you wanted to follow a value investing strategy, you want to follow a dividend strategy, you want to follow George Soros Forex strategy. Here's a model that actually takes all of his variables into consideration and outputs best and worst trades for long and short positions. But what we sort of came to, one of our mentors, he's a fund manager, and he said to us, you can give everyone the proven profitable strategies. You can give someone the best strategy in the world, and the average person will still lose money because they're going to get in at the wrong time and they're going to get out at the wrong time. Because in the end of the day, if you don't have the emotions in check, if you can't check the emotions at the door when you walk onto the trading floor, you're in for a rough ride.
Yes, I agree 100%.
Yeah, it's crazy. And with regards to the signal groups, I wanted your opinion on this statement. One of the things that we sort of talk about with our viewers is that the best traders in the world, the ones that are really profitable, realistically they can't see the future either, right? But what they do have is they have better intuition, they have better resources and better tools. So they are the people who have the market experience to understand what to look for. They are the ones who have the access to the data and the information to apply to what they're looking at, to make sense of it, to quantify or really look into what their edge is, find mispricings, etc. And they're the ones who have the tools to bring this all together. They don't have a magic 8-ball or a crystal ball. You don't need signals. What you need is training.
I agree 100%. I mean, I have some of the screenshots that I post on Instagram. People will send me direct messages asking me if I bought when the arrow points up or if I sold when the arrow points down, and I always tell them no, because if I did that, I would lose money. I use other methods, but it's trading in the short term is not easy. There's definitely the resources, the tools, and the intuition are what a lot of people are lacking.
Mm-hmm. And I think the tough part that a lot of people forget, and you're lucky in the sense you come from an actual professional background in trading, so you have a lot of this just built into you, I'm sure. But a lot of people come into trading with the idea that they can just follow something and it'll work, and they forget the amount of time and effort that really goes in to making it happen.
Right.
Yeah,
I agree 100%. And even with all of my experience, I was expecting some things when I first started to work, and they didn't.
Yeah.
But then the reason they did, well, there's a few reasons why they didn't work. One of the major problems I had when I first started is I used too many strategies. I made things more complex than they should have been. And once I simplified things, I went down to a couple of strategies only. That's when things got more clear to me, because I would be looking at the 1 minute chart, the 5 minute chart, the 15-minute chart. I'd be looking at MACD. I'd be looking at an advanced declining indicator. I'd be looking at all kinds of different things at the same time, and it just created too much noise.
Mm-hmm.
So, in my opinion, for me, and it works different for different traders, the simpler the better. And you can even add to the fact that I hear a lot of traders say that you have to find the strategy that fits your personality. I don't necessarily agree that it's your personality, but one has to find the strategy or strategies that just work best for them. A trader who I follow is John Carter of Simpler Trading.
Okay.
He likes to trade vertical spreads.
Mm-hmm.
I don't like vertical spreads. I trade them periodically, once in a while, but it's very rare that I do them. But he trades vertical spreads all day long, and it's just something that I don't particularly care for. And there's others who love it. There's a lot of traders who like to sell call options naked. I don't. That's not me. I'm not.
I agree with you on that front where there's a lot of people who overcomplicate things. What do you think was your biggest misconception when you were trading, once you began like full-time trading your own capital?
My biggest misconception was that I thought it was going to be a lot easier than it actually was. And part of that was all of my training, all of my work experience working in the capital markets in New York City. I just thought I was going to be able to start trading immediately, be profitable on day one, and never ever have any issues, particularly managing my emotions. And I found out immediately that I am going to have trouble. So my first official trade, my first official day trade, I initially started off trading stocks. It was a year or two later where I started to trade options. I knew options well, but I just didn't trade them at the time. My first trade with a stock, I made over 100% holding it over a weekend. I bought it on a Friday, held it, and Monday midday I had over 100% gain. And it was actually a company I used to work for. I used to work for Citigroup. I ended up Citigroup had plummeted below $5, and it went below $4 on a Friday. And I said, you know what, I'm gonna buy it. Somebody's gonna come in and they're gonna work out some type of deal and save Citigroup over the weekend before Citigroup goes completely bust.
Wow.
So I bought it and over 100% gain that Monday.
Wow, I guess that's time to break out the good whiskey.
And that's when I decided, okay, now I'm going to do this full time. I was recovering from a surgery. I had like a hernia. I was recovering from that, and I said, that's it. I'm doing this full time starting now. I'm not waiting until I'm in my 50s. Now is the time to do it. And I continue to have some good success because price swings were so wide at that time. I started officially in 2008.
Oh wow!
Price swings are around 2008ish.
Right at the bottom, or right at the start of the crash, I suppose.
Right. So I had some success that was really based on the fact that the volatility that we were having gigantic bounces off of lows, and I was catching those bounces. I really wasn't shorting anything at that time. I was catching big bounces.
Mm-hmm.
And then once things got more normal, that's when I started to encounter some issues, and I ultimately was able to work them out. So for the most part, I was able to be profitable.
Wow. So to this day, if you don't mind me asking,
sure.
Overall, it's been profitable for you.
Yes.
That's fantastic. So obviously at this point, you've been trading at least for about 10 years your own capital.
Yes.
Which is, a lot of time, more than I think most of our viewers will be doing it. A lot of the people that on a daily basis are listening to what we do are maybe in their second or third year of trading their own capital. And, having time to see market changes and to go through the highs and the lows, what would you say is your number one piece of advice for someone who's earlier in their trading career, or perhaps even someone later on? What if you could tell every trader one thing, what would it be?
If they want to, if educate themselves as much as possible. There's really more than one thing I have to tell them, but to educate themselves as much as possible, and not. You hear the statistic all the time that 90% or more of all traders fail. It's probably more than that. It's probably 95% or more, maybe even 99%. They fail because of a lack of education, and the biggest factor as part of that education is ability to manage their emotions. And
what do you think it takes to manage your emotions well? Because I know from an institutional perspective, right? I watched an interview with Kenneth Griffin, who is the CEO of Citadel.
yes.
And I watched this interview with him, and he was telling us that, at this high frequency level where they're doing high frequency trading, he said that their best traders, their best portfolio managers get it right 52% of the time. And the question for him was, how on earth do you sleep at night when you're managing $1 billion and walking such a fine line between success and failure? And his response was basically, it came down to risk management, and it came down to having tools that gave them a reasonable understanding of what to expect in the future. So he was coming from a more like mathy kind of approach, but what they were looking at was like, it's sort of, think of it like they were looking at it like a casino, right? So where
Right.
they were able to find strategies where they had a slight edge in the market. So they actually could quantify that they had like a 53%, 52% chance of winning. And then they would just manage their risk and place as many bets as possible
Right.
to see that edge kind of play out over time. And he said that the only way they were able to do it was thanks to the evolution of technology. The fact that they can now use computer power to sort of support them in this, this direction they're heading. But obviously the average trader doesn't have access to all this type of technology. But what do you think it really takes to manage your emotions? How are we supposed to do that? Because everyone talks about it, but not everyone does it.
Yeah, it's actually extremely hard, and I actually find myself at times doing things I should not do because of my emotions. As an example, just seeing a price surge higher and then just jumping in, thinking it's going to keep going higher.
Oh yeah.
For me, and it's different for different people, but the to manage my emotions and try to keep my emotions out of the process, I have a trading plan that I create a trading plan every single day. It's always written down. It's very brief. It's not super. It's not so much that I can't just look at it and understand it clearly. But when I'm doing scalps on options, my target is a 10% gain per transaction. If it keeps running, I try to stretch it to 20%. If it's losing, I try to cut it by a 10% loss, no matter what.
So, is that of your portfolio or of what was allocated for the day?
This is what I've allocated to a particular trade, to an individual trade. Yes, as far as my trading capital, I have a rule that I cannot lose 5% in one day, and the reason that's my rule is real simple. That's my rule because market makers. If a market maker loses more than 5% in one day, he's automatically fired from. He's fired. He's gone.
Yeah,
he's gone. He's gone. So I implemented the rule. I cannot lose more than 5% of my capital in one day, and it's very rare that I actually ever even do a transaction that's even up to 10% of my capital. That's generally about the most that I would allocate to a trade. So that would give me the leeway to lose 50%. I'm gonna try never ever do that. But to manage the emotions, I have to religiously stick to my plan. So if I do go down 10% on a near expiration, at the money, or one strike price out of the money call option, I have to cut. And a lot of times I'm not able to close out that trade until I'm already down 20% because prices might be moving so fast. And then I just have to live with it. And, but if I stick with that and I can just be right 50 to 60% of the time, and I let a few winners run where I'm able to get the 20% or 30% gain, I'm profitable right there. That puts me into profitability. So that's why I have those rules in place. And when I have had big losses, meaning I lose 30%, 40% or more on a particular transaction, it's because I don't follow my trading plans, because I just make the decision, you know what, I'm down 10%, I'm going to hold, we're right at a resistance, we're about to hit a resistance level, it's going to bounce. That's when I run into problems. So education,
you let it keep running down,
having a trading plan.
Maybe it bounces, maybe it doesn't.
Sticking to it. Right. Sticking to it and not just hoping to win. You got to put yourself in this
I agree.
Statistical probability to win, and by having a plan and sticking to a specific loss level to keep those losses small, that helps traders win as traders. It helps you stay in. I had a friend who called me. He had about a $25,000 account, and he had it split among like 5 different tech names, and he was down 50% when he called me. He said, "Greg, what do I do?" I said, "Sell everything right now." I looked at what he had. I said, "Dude, those are going down further. You're going to lose 100%. I said, "Sell everything right now, and at least you have that 50%. You can live the trade another day, or at least you have that 50% of your that trading account available."
Don't try and catch a falling knife.
He did not sell. He lost 100% of that.
Oh, Jesus.
He was able to continue living life. That's not, it's not going to destroy everyone. But, he lost money he did not need to lose. And that's because he did not have a trading plan. He did not have a risk management plan in place. And he let a loss run. And most traders, including myself, have let losses run too far. But if I can impart any wisdom, don't let the losses run. You hit a certain level, you got to cut it. Even if even if you did a large transaction and you're down 20%, you're like, man,
bite the bullet.
This is more than I want to lose. Just go ahead and lose it. I've had a situation. I had a situation where I did really bad, and I lost. I'll say what I lost. I lost $22,000 in one day, and I was furious. I overtraded. I emotionally traded, overtraded, losing $2,000 here, $2,000 there, $2,000 here, $2,000 there, and then I was like, okay, I'm gonna make it all up in 1 or 2 trades.
Oh no!
And so I didn't make it up in 1 or 2 trades. So over the course of maybe the next week, I lost another $17,000. So now I'm sitting.
So you were down 40 grand almost.
This is like a short period of time to be down this much money. So initially, what I did was I wrote a plan. I said, okay, I'm going to try to make 5% back a day. 5% of that back a day until I've made it all back. And what I ended up doing is I ended up just ripping that plan up. I'm not going to focus on 5% a day. I'm not going to focus on just making back that money. What I'm going to do is I'm just going to focus on trading well. And if I trade well, I will make that back. I'll make that back and more. And then I'll look back and think about how stupid I was to eat a big loss and then follow it up by trading poorly and making the loss even bigger. So what I did was I inched along and I cut my size down to much smaller than what I normally trade, and I just made sure I traded well. And it probably within a few weeks I had actually made up all of that.
Wow.
I made it all up within about 3 weeks.
Yeah, that was
Focusing
probably
on
a very
trading
good
well
versus trading plan.
taking more risk and trying to do some
And chasing the loss.
trades that are going to give me 50% gains in 3 hours. No, I just played every. I implemented greater risk management going forward, and I was more selective on the trades I did. I was more patient, and that was I wouldn't say that was it wasn't a turning point, but it was a well, technically it was a turning point. It was a turning point in that I was never ever going to, and hopefully I never end up doing it again, emotionally trade where I'm doing trades that I should not do, eating loss after loss after loss. So I've got it down to the point where I actually try to do as few trades a day as possible. If I can do 2 trades or 3 trades and be done, that's it. It's my perfect day. If I can do 1 trade and be done, it's my perfect day. And I've set a limit. If I have a certain level of profitability, by 10 or 11 a.m., I have to stop trading for the day. And that has saved me from getting caught in midday chop.
Yeah.
And
so I have two last things I wanted to ask you here.
sure.
One was, this has been a really interesting year so far for trading. At the time of this podcast, it's 2020, March 2020. Yes. Going through we had halts put in place yesterday. It was insane what's going on right now. So I wanted to ask you this. This doesn't have to be just trading related because, looking at your website, I see you also do speaking events. You've written a book. You've done a lot of different things related to finance. What are your goals for the next 12 months? Do you have anything planned?
In terms of
finance,
trading?
Career?
Well, I actually have another book that I've been wanting to finish, and this actually is a book on finance. So I'd like to complete that in the by the end of 2020. That's one thing I have planned. It's not going to be a super long book, but it's going to be a book that's going to help new and experienced traders alike with a couple of strategies that I employ that tend to work for me most of the time. And so that's one of the things that I have planned. And in terms of trading, my personal trading, I just intend on continuing to trade well. I have a particular daily goal I try to achieve. Sometimes I make it, sometimes I don't. If I don't make it, I don't beat myself up.
Mm-hmm.
If I do make it, I don't let my ego get too big that I've achieved a certain level of success on an individual day. And as long as I focus on not letting losses get too big, and I am patient, I will be successful.
Amazing. With what you shared there, you actually nailed both my questions right there. So I wanted to ask you about a next book. But Greg, I want to thank you for your time here. We hit just about an hour here.
My pleasure, Sean.
I learned a lot. I really appreciate this call.
Oh, my pleasure.